Hello, 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 beautiful people, powerful people. Um, how are you today? What's happening for you? This is Millen Livis, your financial independence mentor, and I'm happy to be with you today. There are a lot of things happening in the world right now. War, unfortunately, inflation, unfortunately, problems at the borders, etc. But today we'll talk about taxes. Not my favorite topic, but an important one. Ta-da! We're getting close to National Tax Day. This year is April 18th. I think it should be declared as a national holiday. What do you think? Just kidding. Nobody likes paying a lot in taxes, let alone having to deal with unexpected tax bills that can ruin all your other plans, right? I just received a crazy tax bill that I have to pay because I'm winding down a little bit in my business, and I sold one of my properties last year with a nice profit. And even though I don't mind to pay high taxes because it shows that I have high income, right? I don't like to pay more than I have to. Everybody wants to know how to pay less taxes legally and ethically, right? Would you agree? Well, fortunately, there are tax strategies that make lowering your taxes possible. Now, full disclosure, I'm not an accountant, and you cannot take this educational training as a form of any kind of advice, accounting advice or financial advice. Also, tax strategies are not my forte, to be honest with you. I studied them because I don't like to pay more in taxes than I have to, right? So if you want to delegate something to a professional, you better know what you're talking about. That's why I studied tax strategies. And so today, I will share with you legal and ethical ideas about how you can save money on your taxes, which these ideas I use in my life, and I recommend these ideas to my clients. Please note that I will not share all great tax strategies, tax saving strategies that exist out there, but I decided to share 8 of them that I find most important for you to be aware of. Why 8? I like number 8. Okay, so for a complete and customized to you tax saving strategies, I suggest that you talk to your accountant, to your maybe financial planner or financial advisor. All right, let's begin. Strategy number 1, use tax deferred retirement accounts. You get taxed based on your income and how big it is. On your income and the size of your income, right? So the higher the income earners, the higher the income, the higher you will pay taxes. That's why high income earners sometimes pay high taxes, not always. Fortunately, you can reduce the taxable income every year by contributing pre-tax money, meaning money that you haven't paid tax on yet. You can contribute pre-tax money to your tax deferred retirement accounts, like in the States called 401k, IRA, or rollover, traditional IRA or rollover IRA. The amount you contribute directly to these retirement accounts is not taxed by the IRS. The contributions to these retirement accounts are capped, meaning there are limits on how much you can stash your money into these accounts pre-tax. The allowed contribution amounts change almost every year, so you can find these amounts online. But just to give you an idea, in 2021, you could contribute up to $90,500 US into your 401k account. And if you reach the age of 50 and above, you could stash an additional $6,500 into your 401k. On top of that, the 401k retirement accounts are often sponsored by your employers if you are an employee. But if you are self-employed, you can still open the 401k account if you want to. So you can put your pre-tax money there and invest. You can also open and contribute to an traditional or rollover IRA account to help you reduce taxes as well. Okay, so these are all tax-deferred retirement accounts. Keep in mind that IRAs have their own limits in terms of how much you can contribute to them, right? So different from 401k. And again, to give you an idea of the allowed contributions to IRA accounts, in 2021, you could contribute up to $6,000 per year. And if you're 50 or over, you could contribute $7,000. So this is just an idea, but every year these amounts change, so always check. By the way, you can fund your IRA and 401k retirement accounts for the previous tax year until the deadline that always happens in April, mid-April in the States, and this year it's April 18th. So whether you are self-employed or not, putting your money into retirement accounts that are tax deferred, like IRA and 401k, shields your money against the taxes because you don't pay tax on this money when you contribute to these accounts. And by the way, the most common reason why retirement accounts are overlooked and frankly underused, because number one, these accounts have certain contribution limits, so it's a little bit slow but a steady approach, right? And also the second reason is because you cannot withdraw your money from these retirement accounts without paying penalties and taxes until you reach 59 and a half years old, right? Which is nearly retirement age. However, these accounts shouldn't be overlooked, in my opinion, because they create a compounding effect over the years when you contribute consistently. Okay, so I hope it's not too boring for you. Like I said, sometimes we have to do things that we have to do to educate ourselves, to be informed. Okay, strategy number 2 is become a business owner or become an entrepreneur. It's known that businesses have the most leverage when it comes to tax credits, tax deductions, and tax write-offs. It's known. Then why not find a way to leverage your interest, your experiences, your goals, right? And frame all of this into some kind of business idea. Okay, you've got to be creative here. As a business owner, and you can use different legal entities to represent your business. It could be an LLC, it could be S Corp, it could be C Corporation. You can ask your accountant or financial planner advice which form of legal entity would fit better for your business. But you'll be able, if you form this, you'll be able to have more deductions than as an individual. Okay, you'll be able to deduct more taxes than an individual. And by the way, each time you expect to have high revenue in your business, try to coordinate this income with some kind of deductible expenses in your business, like investing in your hardware, software, right? Maybe computers, maybe some software for your computers. Invest in your education, invest in your team, grow your team, and invest in your team education, etc. And here's the big tax tip for you to remember. Reinvested profits are not taxed. If you have profits from your business and you reinvest them into growing your business, you don't pay tax on the reinvested money because they are this reinvested money is your business expense. Okay. All right. So if you have any questions, by the way, please put them in the comments. I would be happy to answer them. And let's move on to strategy number 3, which is become a strategic investor. The golden rule when it comes to paying less in taxes is to defer paying taxes on your income as much as possible. And most wealthy people don't take cash from their investments unless they absolutely need it. What they do, they reinvest their profits from the investments into more investments. And here's the big tax tip for you to remember. Reinvested profits from your investments are not taxed. In other words, if you have profits from your investments like dividends from a dividend paying stocks, and you reinvest this money into more of the stock shares, instead of taking this cash out, you will not pay tax on these dividends until you decide to sell the stock shares and take the cash out, okay? So if you hold the stocks for 1 year or more, you pay capital gain on this money instead of income tax, your income tax bracket percentage, which is usually capital gains amount is less. If you need to take tax deductions, it could be a good idea for you to sell any underperforming stocks or any other assets to offset some capital gain that you may have in a particular year. For more specifics, consult your accountant or financial advisors. Now, real estate investing is close to my heart. Real estate investing is one of the most popular tax savings options because you can deduct repairs, property management, property insurance, depreciation, etc. That's one of the main reasons I love real estate investing. Okay, let's move on to strategy number 4, which is take depreciation deductions on hard assets. To be financially independent requires having passive income, right? We all agree on that. So how do you get passive income? There are different ways to generate passive income. One of the ways is to own some hard assets, like a piece of real estate or business equipment like a computer or other equipment that you can depreciate year after year, okay? And you can deduct depreciation on your property and equipment over some period of time. For example, you make, let's say, $1,000 passive income, and you have $1,500 in depreciation on your asset, right? Which referred to as passive loss because you have more expenses than your income. So it's a passive loss because it was passive income. So in this case, your tax return will show 500 in passive losses. This is one of the reasons why people love real estate investing, because some love it for depreciation, because you can depreciate the value of your asset over time. And, that's why some people love it more than stock investing. I love it equally. So please note that you can only write off passive income with passive losses, right? You cannot offset passive income against your active losses and vice versa. Okay, so today we covered first money saving tax strategies training. So we covered 4 of them. So the first strategy was use tax deferred retirement accounts like IRA, traditional and rollover. Roth IRA, you contribute to Roth IRA after tax money. So you can use 401k, you can use IRA accounts, use tax deferred retirement accounts. That was strategy number one. Strategy number two, become a business owner, become an entrepreneur. Strategy number three, become a strategic investor. And strategy, tax saving strategy number four that we discussed today was using depreciation deductions on some assets, hard assets that you own. Okay, that's all that I have for today, for today's training. If you want to uncover roadblocks to your financial success that you may have at the moment, and if you want to discuss specific customized to you strategies, how to remove these roadblocks, book your complimentary consultation with me. Never worry about money again at this link as soon as possible. This is not the time, my dear, to be wishy-washy about your money and your financial future. It's not the time. It's actually very challenging time that we're living through right now. If you don't control your money, it will control you. Thank you for your time today.